One bank says gold could reach $4,500 by the end of this year. Another is calling for $5,000. And then you have Robert Kiyosaki making an extraordinary prediction of $35,000 gold. Three completely different numbers, three completely different assumptions. And yet here we are, watching gold struggle even while geopolitical tensions remain elevated. So what is actually happening? Because if gold is supposed to be the ultimate safe haven asset during war and uncertainty, why isn't it simply exploding higher? That is the question we need to answer today. Welcome back to Macro Bullion. I'm Alex James, and I break down gold, silver, and the broader economy using market data and straight analysis, without hype or fear-mongering. And today's story is important because the relationship between gold, oil, interest rates, and geopolitical risk is not nearly as simple as the headlines make it sound. Right now, tensions involving the United States and Iran remain an important factor in global markets. Oil has climbed again, with Brent recently moving above $90 a barrel as uncertainty around the Strait of Hormuz continues. Normally, you would expect that kind of geopolitical risk to send investors rushing toward gold. But here's the twist. Gold can react to a crisis in two completely different ways. The first effect is fear. Investors become nervous, demand a safe haven, and gold can benefit. The second effect runs through inflation and interest rates. If a geopolitical crisis pushes oil prices sharply higher, that can increase inflation pressure. And if inflation remains stubborn, investors may start expecting interest rates to stay higher for longer. That matters because gold does not pay interest. When treasury yields rise, the opportunity cost of holding gold rises as well. And we've seen exactly that dynamic recently. On August 18th, U.S. long-term treasury yields climbed sharply, with the 30-year yield reaching levels not seen since 2007. Gold subsequently came under pressure even though geopolitical tensions remained intense. So the market is telling us something very important. War does not automatically mean higher gold prices. The market is constantly weighing several forces at the same time: geopolitical risk, oil prices, inflation expectations, treasury yields, the dollar, and expectations for Federal Reserve policy. And right now, that battle is happening directly in front of us. Gold has recently recovered toward the $4,300 area after the sharp decline, with Reuters reporting spot gold around $4,337.59 on August 19th. Investors are now watching the Federal Reserve's July meeting minutes for clues about the future path of interest rates. That creates the bigger question. Is this simply another correction inside a much larger gold bull market, or has something fundamentally changed? Because if you're looking only at the latest price movement, it is very easy to become convinced that the gold story is broken. But zoom out, and the picture becomes much more complicated. Gold has already experienced an enormous move over the past year, and major corrections after powerful rallies are not unusual. The important thing isn't simply whether the price has fallen from a previous high. The important question is why it fell, and whether the forces that created the long-term bull case are still intact. And that's exactly where this analysis gets interesting, because over the next few minutes, we're going to separate the short-term pressure from the long-term story and look at what the market is actually telling us, not what the headlines want you to believe, not what the most extreme prediction wants you to believe, but what the underlying market mechanics are saying right now. So now let's get to the real question. Why has gold been under pressure even while geopolitical tensions remain elevated? The answer is more complicated than simply saying war is bullish for gold. Gestau with Kashturkau. The key mechanism runs through oil, inflation, interest rates, treasury yields, and the US dollar. When geopolitical tensions threaten energy supplies, oil prices can rise, and when crude oil becomes more expensive, the inflation outlook can become more difficult for central banks. That matters because the Federal Reserve doesn't set policy based only on whether investors are worried about war. It has to consider inflation and financial conditions as well. And this is where the gold trade becomes complicated. Gold doesn't generate interest or dividends, so when treasury yields rise, investors have a stronger financial incentive to hold interest-bearing assets, instead of an asset that produces no regular income. We've just seen a very clear example of that relationship. On August 18th, the US 30-year Treasury yield climbed to about 5.327%, its highest level since 2007. While oil moved above $90 a barrel, gold then suffered a sharp one-day decline. That doesn't mean the long-term gold story suddenly disappeared. It means that in the short term, the bond market was exerting enormous pressure on precious metals. And here's the important distinction. Gold is not simply a war hedge. Gold is also a monetary asset. When investors expect lower rates, falling real yields, or a weaker dollar, gold can become more attractive. When investors expect higher yields and tighter financial conditions, gold can face pressure. That's why the same geopolitical event can sometimes produce a surprising reaction in gold. Oil goes higher. Inflation expectations become more complicated. Bond yields rise. The opportunity cost of holding gold increases. And suddenly the traditional safe haven trade is competing against a powerful yield trade. But there's another side to this story. The recent inflation data has actually helped gold at times because softer economic numbers can reduce expectations for additional Federal Reserve tightening. Reuters reported that gold recovered as Treasury yields eased, with investors turning their attention toward the Federal Reserve's July meeting minutes for clues about future policy. That is why you can see gold move higher one day and lower the next, without the underlying long-term thesis necessarily changing. The market is constantly repricing the probability of what the Fed does next. And right now, that probability is still one of the biggest drivers of gold. The latest market data also shows how quickly sentiment can change. Gold has recently been trading around the $4,300, $4,400 area after recovering from its earlier decline, while analysts continue to watch the $4,500 region as an important technical level. So when someone looks at the chart and asks, why isn't gold exploding because of the geopolitical crisis? The answer is that the market isn't looking at just one variable. It's looking at the entire chain. Geopolitical risk affects oil. Oil affects inflation expectations. Inflation affects Fed expectations. Fed expectations affect Treasury yields and the dollar. And those variables feed directly into gold. That is the mechanism. And once you understand that mechanism, the recent price action starts looking much less mysterious. But there's still another important question. If this is simply another correction caused by interest rates and yields, has gold experienced anything similar before? Because the difference between a temporary correction and a genuine structural change is absolutely critical. And that's where the longer-term gold chart becomes much more interesting. Now, here's where the story gets really interesting, because if you only watch the daily gold chart, you can easily miss what some of the largest players in the global financial system are doing underneath the surface. While short-term investors can react quickly to Treasury yields, the dollar, inflation data, and Federal Reserve expectations, central banks tend to think on a completely different time horizon. And the latest data shows that official sector demand for gold remains significant. According to the World Gold Council, central banks and other institutions purchased an estimated 243.7 tons of gold in the first quarter of 2026, up 17% from the previous quarter. Poland and Uzbekistan were among the largest buyers during that period, while Turkey and Russia were among those reporting sales. That distinction matters because central banks aren't generally buying gold because they think the price will jump tomorrow morning. They're managing reserves. They're thinking about currency diversification, financial stability, geopolitical risk, and the long-term role of gold as a reserve asset. And that creates an important contrast with short-term market positioning. One group can be selling because yields are rising. Another group can be buying because it wants to reduce dependence on traditional reserve assets. Both things can happen at exactly the same time. That's why I don't think the current gold correction should automatically be interpreted as proof that the entire bull case has disappeared. Look at what happened recently. Gold dropped almost 2% on August 18th as U.S. Treasury yields surged, with the 30-year yield reaching its highest level since 2007. Then, on August 19th, gold stabilized around $4,337 an ounce as Treasury yields eased and investors waited for the Federal Reserve's July meeting minutes. That's a perfect example of the difference between short-term price pressure and long-term structural demand. The daily price is responding to the bond market. The longer-term demand picture is being influenced by central bank reserve strategy. And there's another important point here. Retail investors often look at gold after it has already made a huge move. When prices are rising rapidly and headlines become increasingly bullish, more people suddenly become interested. Then when the market pulls back, the emotional reaction can be just as powerful in the opposite direction. That's where investors can get trapped by their own time horizon. They buy because they believe gold is a long-term hedge against inflation, currency risk, or financial instability, but then the price falls for a few weeks, and suddenly they start judging the entire thesis based on the latest candle on the chart. Those are two completely different decisions. If your thesis was long-term, you have to ask whether the underlying conditions supporting that thesis have actually changed. Has central bank demand disappeared? No. Q1 demand remained strong. Has gold suddenly started producing income? No. Are Treasury yields irrelevant? Absolutely not. And has the Federal Reserve's policy outlook become unimportant? Quite the opposite. The market is watching every inflation reading, every employment report, and every Fed communication because those expectations can move yields, and yields can move gold. That's why the real battle isn't simply between gold bulls and gold bears. It's between two forces. On one side, you have higher yields, inflation uncertainty, and pressure from the bond market. On the other, you have geopolitical uncertainty, central bank demand, currency diversification, and concerns about the long-term stability of the global financial system. And right now, neither side has completely won. That's the most important takeaway. So before anyone tells you that gold is either guaranteed to crash or guaranteed to explode towards some extraordinary price target, remember what the market is actually showing us. Gold can be under short-term pressure while the long-term demand structure remains intact. And that brings us to the next question. If the long-term story is still alive, how should we think about all those wildly different price targets? $4,500, $5,000, or even much higher, because those forecasts can sound incredibly confident. But confidence and certainty are two very different things. Now let's go back to those dramatic price targets, because this is where gold analysis can easily turn into headline chasing. You've probably heard numbers like $4,500, $5,000, $6,000, and then you have Robert Kiyosaki talking about $35,000 gold. That is an enormous gap, and it tells us something important. These forecasts are not simply different estimates of the same outcome. They are based on very different assumptions. Kiyosaki's $35,000 call is tied to a much more extreme scenario involving a major financial system disruption. It is not the same type of forecast as a conventional bank target, and that distinction matters. On the institutional side, forecasts are much more measured. JP Morgan's current research projects gold averaging around $6,000 per ounce in the final quarter of 2026, with a longer-term path toward approximately $6,300 by the end of 2027. Other institutional estimates have also been clustered much closer to the $4,500 to $5,000 range, depending on assumptions around Federal Reserve policy, Treasury yields, the dollar, and central bank demand. So when you see a $35,000 prediction sitting next to a $4,500 or $6,000 forecast, don't simply ask which number is correct. Ask a better question: what has to happen for each number to become realistic? That's the analytical framework that matters. A $4,500 target could be consistent with a market that remains strong but faces persistent pressure from elevated yields. A $5,000 or $6,000 scenario could require stronger investment demand, easier monetary policy, continued central bank accumulation, or a weaker dollar. A number as extreme as $35,000 would require a fundamentally different financial environment, something far beyond a normal gold bull market. And this is why investors should be careful with precise predictions. A forecast is not a guarantee. Even professional institutions change their targets when the underlying assumptions change. In fact, several major institutions have adjusted their 2026 gold expectations as the outlook for Federal Reserve rate cuts shifted. That brings us back to the chart. If gold is trading below a previous peak, the temptation is to think the bull market is over. But price alone doesn't answer that question. You need to watch the variables underneath the price. Watch Treasury yields, watch real rates, watch the dollar, watch ETF flows, watch central bank purchases. And most importantly, watch Federal Reserve expectations. If yields continue moving higher and the dollar strengthens significantly, gold could remain under pressure even if geopolitical uncertainty stays elevated. But if yields begin falling, the dollar weakens and investment demand returns. While central banks continue accumulating, the environment could become much more supportive for gold. That is why I would not build an investment decision around one headline number. Not $4,500, not $5,000, not $6,000, and certainly not $35,000. The more useful question is whether the fundamental conditions behind your original gold thesis are still present. And that brings us to the final part of this analysis. Because after separating the short-term pressure from the long-term structural story, we can finally answer the question that matters most. What does all of this actually mean for gold from here? And the honest answer may be more nuanced and more useful than simply saying gold is going up or gold is going down. So let's bring everything together. The most important thing we've learned is that gold's recent weakness does not have a single explanation. Gold has been caught between two powerful forces. On one side, geopolitical tensions and continued central bank demand are providing structural support. On the other side, rising treasury yields, elevated oil prices, and uncertainty over Federal Reserve policy are creating short-term pressure. And we're seeing that battle play out in real time. On August 18th, gold fell nearly 2% as U.S. Treasury yields surged. But on August 19th, the metal stabilized and moved back above $4,300 as Treasury yields eased. Reuters reported spot gold around $4,337.59 per ounce, while investors waited for the Federal Reserve's July meeting minutes. That reaction is extremely important. It tells us that the bond market is still one of the biggest short-term drivers of gold. Higher yields can make a non-yielding asset less attractive, but when yields stabilize or decline, some of that pressure can disappear very quickly. Gold's move on August 19th is a good example of how rapidly sentiment can change. So what should we watch from here? First, watch Treasury yields. If long-term yields continue climbing, gold could remain under pressure even if geopolitical risk stays elevated. Second, watch the Federal Reserve. The market is waiting for the July meeting minutes because investors want to understand how policymakers are thinking about inflation, growth, and future interest rate decisions. Third, watch the dollar. A stronger dollar can create additional pressure on gold, while a weaker dollar can make the metal more attractive to international buyers. And fourth, watch physical and central bank demand. The long-term gold story isn't determined by one day's price movement. Reserve diversification and official sector demand remain important parts of the bigger picture. That's why I would be extremely careful about treating any single price target as a guarantee. $4,500 is not guaranteed. $5,000 is not guaranteed. $6,000 is not guaranteed. And an extreme prediction like $35,000 is certainly not something investors should treat as a certainty. Those numbers represent different assumptions about the future. The better approach is to watch the variables that can actually move the market. If yields fall, Fed expectations become more supportive, the dollar weakens, and central bank demand remains strong, the environment could become increasingly favorable for gold. If yields keep rising, inflation remains sticky, and financial conditions tighten, gold could face another period of consolidation or downside pressure. That means the next major move may not come from another geopolitical headline at all. It could come from the bond market, it could come from the Federal Reserve, or it could come from a sudden change in expectations about inflation and interest rates. And that is why I don't think the right question is simply, is gold going to $5,000? The better question is, what conditions would have to exist for gold to get there? Because once you understand those conditions, you stop reacting to every headline and start understanding the market. So here's the question I want to leave you with. Has the original reason you were interested in gold actually changed, or has the price simply moved? That's the distinction every investor needs to understand. As always, this is not financial advice. Market conditions can change quickly, forecasts can be wrong, and past performance does not guarantee future results. Do your own research before making any financial decision. If you found this breakdown useful, subscribe to Macro Bullion, because we don't just follow the gold price, we follow the economic forces behind it. And let me know in the comments, do you think gold's next major move will be driven by the Federal Reserve, Treasury yields, or geopolitics?